I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer, specializing in custom strategies because guess what? This time is not different. They always want you to think that, but let's take a look at what the bond traders think. Oh, they bet on Nirvana in new decoding of the yield curve. Yeah, let's just say that it's different than it is, even though it never is. I think that's hysterical when they want you to believe that, but that's why I don't want you to take my word for anything. I definitely don't want you to take their word for anything because they have an ulterior motive. I give you all of my resources, or at least a chunk of them. Go ahead, see if this time is different, but it's not. And that's what they say. Many see reasons why curve inversion may not be a recession signal. And a lot of people have said, well, we've been waiting for this recession. I got news for you. For many people, the recession never ended after 2008. For others, yeah, the 1%ers, they're doing just great. There's never a recession at all. But this time may be the last time that they're able to pull a rabbit out of their hats when we're looking at this. Because you look at this inversion going all the way back to 95, and it's much, much deeper. So what is that really telling you? In my opinion, what it's really telling you is that this next crisis is going to be much, much worse. And it is, because we're at the end of the currency's life cycle. Listen to Wall Street's top economists and you'll hear the same message again and again. The risk of a recession is fading fast, and yet in the bond market, the traditional warning that a downturn is near, an inversion of the yield curve, keeps getting louder. Yes, it does keep getting louder because things keep getting more precarious. And frankly, insanity, it's doing the same thing over and over and over again, yet expecting different results. It's never different. I don't care what they say. What they want you to believe is that this time is different. Keep your wealth in the system. That's their job. They can't be honest with you because then you might do things that would protect your wealth. You might take your wealth out of the system, making it much harder for them to steal. Don't listen to them, because we just had a 30-year bond auction, a treasury bond auction, signals weak demand to wrap up the week of big sales. Remember, this quarter, they're planning on issuing another $1 trillion worth of debt. And every time they do that, the value of all of the money that's already out there, that fiat money, goes down. It is truly just that simple. They want to make things so complicated because what they tell us is that if they make it really complicated, nobody questions us. Well, you better start asking the questions and you better start getting prepared, because we are seeing so many signals that the system is imploding. And in fact, today, we even got notification from Moody's that they're about to downgrade a whole bunch more banks, including JP Morgan Chase. And oh, by the way, did you see what happened with Argentina and the overnight surprise devaluation? Okay, when do you want to get ready? You want to get ready in advance. And you're not going to be able to do it if you think that you're going to be able to do it right before. Why would you want to put that much stress on yourself? But week of big sales indicates market is struggling to absorb deals. Uh-oh. Well, all right, we're going to talk about more about what the Federal Reserve is doing with their bond buying. But if they're counting on the market to do it, well, who would that be in the market? Oh, probably institutional investors that are investing your money. because they don't care. They don't really have skin in the game. You have the skin in the game, and you're the one that will eat it in the shorts when this thing blows up. And in the meantime, in order to even sell what they did, you've got the 30-year high yield at sale. I mean, this is telling you that we've got big problems. They have to pay more. And remember, we just had a downgrade from Fitch on U.S. government debt. What does that mean? Well, if you're an individual, you know very well if you're going to borrow money, the lower your credit score, the higher interest you're going to have to pay. Governments are no different. You know, essentially what they're telling you is that government debt, and I don't care where you are in the world, but certainly in the U.S., that's the safest thing that you can do. Oh, really? You don't need Moody's or S&P or Fitch to tell you that this is the safest thing you can do. That's why all the global central banks have been buying so much of it. This is the highest yield on a 30-year bond since 2011. What was happening in 2011? Oh my God, we were still inside of the crisis and people were still nervous. What's that tell you? Tells you better get to safety as quickly as you can. Weak demand. And as we said, the most powerful buyers in treasuries are all bailing at once. This was back in October of 2022, so not a year ago, but we've seen this exodus. So the smart money are not buying the treasuries, and the treasuries are the bedrock, the foundation of the global financial system. Do you see the problem here? Because Fed, foreign governments, commercial banks are all stepping back. And who's stepping into their place? Oh, institutional investors. So there's more pain for bond investors may be in store amid buyer void. So this is not something that just happened. It's something that has been happening. This isn't something that's going to happen into the future. It's just going to get worse in the future. And what you're looking at here is the Fed balance sheet. And you can see how they've been selling off their balance sheet, which is a combination of treasury securities and mortgage-backed securities. Well, mortgage-backed securities tie into the real estate market. Can you see that the system is falling apart? But how does this happen? Slowly at first, maybe invisibly to most at first, and then very quickly. So you want to be in position before it gets very quickly. And I take this as a really significant sign, because what the Fed is really doing is fighting for their credibility. Because it was a year ago last June when they handed away forward guidance telling Wall Street that they could no longer count on them to tell them the truth. Now, the public still has to learn this, and I certainly wish that they would. I learned it because I worked inside the belly of the beast. And a lot of the people that you see in the space that I'm working in, they also came from a similar background. So when you know what's happening, you make different choices, and that's why we're all trying to warn you. Because if the Fed is fighting for credibility, if that has become their single most important issue, then they don't care what happens to the rest. And the other part of it is everybody always assumes that they're just trying to kick the can down the road, when in reality, since they're really out of tools and they're out of purchasing power, maybe they want a big, huge crisis. Maybe they want it. I actually think that they do. I think that what they're trying to actually orchestrate is a controlled implosion so that they remain in power. But you can't always judge what's going to happen. Unintended consequences when they make a policy error. Are they making one now? Maybe. Because all the technical signals, frankly, are screaming.